All right. GME, AMC, and Tesla. The meme stock market rally is back. And that's what we're seeing here over the past couple of weeks. You're seeing these stocks start to pick up a lot of momentum. GME, Gamestop, it's up over 82% off of the March 14th lows. You have AMC, it's up 60% off the lows from the same day. And then you have Tesla, it's up 32% during that same time. So massive moves. And we'll be honest here too, the Tesla rally also has a lot of institutional buying just because of how big of a company it is. It's a $1 trillion market cap. So it's definitely not just the Wall Street bets crowd that's pushing that stock up. But with the other two, they're trying to do another repeat of what we saw in January of 2021 with GME and June of 2021 with AMC, and then with Tesla back in October, November time period of last year. Now, before I get any further, make sure to hit the like button and subscribe to this channel so you can get notified and ask questions during this live stream. And I'm going to get to all of your charts. I'm going to get to all your questions. I want to hear about them. We'll go over all of them together. I'll go over my stuff, and I'm going to go over your stuff as well. So great show with you guys here today. So make sure you guys are here for it and stay the whole time. Now, one of the big things is I don't see a massive repeat of what we just saw from last year. Yes, the move that we've seen over the past week or two, it's cute, but it's not sustainable. You're not going to see GameStop back at 483, and you're not going to see AMC back at 72. The one that probably can be most sustained is Tesla, just simply because there's so much more institutional interest in those. It's not a institution versus retail kind of a setup. It's institutions and retail are both getting in on Tesla. So I would say Tesla has the best chance of succeeding or going back to its all-time highs. GameStop and AMC, it's just not going to happen. And the volume's not there. Look, here's the other thing too, is what you saw with those big names back in last year, those were really aberrations in the market, just like the fat finger crash back in 2010 of May of 2010. That was an aberration too. Have you seen one of those since then? No, because the market learns, the market corrects itself. There's things that are put in place to keep those kinds of events from happening again, whether it's fair or not. It's the reality. Okay. So look at what Robinhood did when GameStop got crazy. What did they do? They took away the buy button on their app. Okay. What happened just recently with LME and the nickel trade? They just started canceling trades that were legitimate. Yeah, that they weren't going to let those trades go through. So they started canceling them. So the thing here is that you can't expect what you just saw happen last year to repeat itself exactly or even go higher, because the markets learned from that aberration, and those aberrations, they're called aberrations for a reason. That's why you don't see them too much. They're not likely to repeat itself again. So if it was ever to get back up to that high again, it would be something different besides retail hoodling and not giving up their shares and squeezing the hedge funds. I think it's a pipe dream at this point. They're more prepared for it. So don't get your hopes and dreams up. Now, the other thing I would tell you too is that even the traders, the retail traders that make a lot of money off of these trades that got in the GME before it started making its move, let's say they bottom ticked the March 14th lows, and let's say it goes up to $200 a share. Well, they gotta get rid of their position somehow. Let's say they got like $1 million in it. Well, then they're selling it to who? To more retail traders. So what's happening to all those retail traders that are buying it at 200 and then it comes right back down again? They're creating just the scores of long-term bag holders. And that's how it works. So just because everybody wants to hold on to their stocks doesn't mean that there isn't going to be long-term bag holders. And really, trading is an individual sport. You can't worry about what everybody else is doing. It's all about you. And so when you're worried about hodling for this big cause, I keep saying hodling now because I said it one time, but when you keep wanting to hold for some kind of like bigger cause, market doesn't care about that stuff. And you really should be working out of your own self-interest, not some Joe Schmo that you saw on a Reddit board. So with that said, let's look at all of these charts here. And by the way, we're going to get into all like SPY, the Qs, and IWM as well. But I want to focus first on these meme stocks and just give you guys a better idea, because they can be very tempting to want to jump in on these plays. So first off, we have GameStop here. And let me pull up a better chart for you guys. There we go. Okay, so with GameStop, you have this massive spike. Okay, this is the spike that we saw here back on January of last year. Okay, huge spike. People are talking about that being, going to happen again, right? Wrong. That's not likely to happen. First of all, you have a lot of resistance in play here. Here's your first resistance channel. And what else do you also notice about this chart? One, yes, I think GameStop is way overvalued right now. This thing should be trading back at like $19, $20. This is like buying Radio Shack 10 years ago. But if you're looking at it from a fundamental standpoint, but from a technical standpoint, long-term trend line right there in place. You also have what appears to be like another resistance level in place as well. But you'll see every one of these rallies that we've seen, they get less and less over time. It's like they try to repeat it, but they don't have enough momentum to sustain it. Now, the other thing I would say, and I'm going to take the picture-in-picture off to show you guys this, but look at the volume right here that we saw that sent this thing up to 483. Look at the volume right here currently. You're talking about 22 million shares being traded today versus 196 million shares traded back in January of last year. Huge difference. There's not the same amount of interest that we saw back in the day. So, well, this move is nice, and this is some pretty decent volume here in the short term versus what we've seen over the last few months. When you look at it from the grand scheme of things, guys, this volume is, you can't even see this volume compared to the volume that we saw back in January of last year. So don't get too excited about this stock moving. You also have a nice level of support on the stock where it has managed to bounce off of consistently. So if it does come back down, watch the support level, because this is a very key support level going forward here. Now, you have a double bottom, first bottom, and then you have the second bottom, and then it confirmed here recently. So now I'm going over short-term patterns here. But even with this double bottom confirmed, price is breaking out. But what do you have overhead? You have resistance right up here, okay? So we have to make sure that we're not getting ahead of ourselves and thinking we're just going to blow right through this resistance, because history has shown us this resistance level is pretty tough. And so even if it gets through one resistance level, it's got to get through this second resistance level. So 191 and 170 are going to be very key if this rally can continue going forward into the later parts of this week. And while these are big moves, we're talking about going from 141 to 170 or 170 to 190. They're big moves, but people who are trading GameStop, they're looking for these massive moves, and they're not satisfied with just move to 170 to 190. But what satisfies us and what makes us happy in regards to a market return isn't what the market's going to necessarily give us all the time. So you have to keep that in mind, that what our desires are and what our expectations are for a stock isn't necessarily something that the market has to meet or grant the wish of. So that's GME. Now let's look at AMC here. Now here, you could almost say that's like a triple bottom going on here on AMC, right? You have one bottom, two bottoms, and three bottoms. But I actually would probably call this just a double bottom here, right? So we have the double bottom in place. Let me fix that up a little bit here so you can get a little bit more precise. And don't forget, keep posting your questions. I will get to all your questions here on the show. And but check out this declining trend line on AMC as well. What do you notice here? We got all the way up to this declining trend line here today. And what happened? It sold off. So you go back to GME. What does that tell us? There's a good chance that it's going to do the same thing if it gets tested. So maybe AMC is kind of like a precursor for what we're seeing in GME, that it may struggle, in fact, with this trend line. So AMC tomorrow, it's going to be key, absolutely imperative that it doesn't just flounder underneath this trend line. It needs to break through it. And if it does, then it opens up a whole new world of opportunity for it, as it has to go all the way up to about $27, $28 before it hits its next resistance level. So there's another resistance level going back to June of last year. So multiple layers of resistance, just like what we saw with GME, that it has to break through. There's AMC, there's GME. Now let's look at Tesla here. This chart is a lot messier. Let me tell you, this chart, it's crazy. Some resistance overhead. And I don't think that this is the time you want to be chasing Tesla. I've been talking about it, particularly like with the membership on the YouTube membership and also on the trading block. I talked about how this level was a very important trend line. We broke below it, and then you started creating like a secondary trend line there, and it managed to bounce off of it. So, but this long-term trend line has been very, very important for the stock, and it broke below it. And that's where I kind of got, okay, let's see how much further it can pull back. You had a support level here that wasn't that great of a support level, but there was some significance to it. It managed to bottom out right there on that support level and then bounce higher. So with Tesla, you have that support level, and then you have this resistance overhead. There's actually two resistance levels, just like with GME and with AMC, that will be difficult for the stock to break through. You had a double top here in November, and again in late, what does that look like? Early January, and then you had the big sell-off. Now, to its credit, it's done some damage repair on the charts. This was the confirmation for that double top. It broke below it, and then saw the move back down to 700, but then it couldn't quite push through it before it sold off again, and then you had that epic rally off of the 14th of March lows. So now it's kind of like in this no man's zone. Do you really want to be buying it here? No. And it looks a little bit more exhausted today. Doesn't mean it can't go up tomorrow, but you want to start taking notice of some of these candles, like what we saw here today. Can it really sustain that momentum up to 1100 or not? That's going to be the big question going forward. But out of the three, Tesla, AMC, GameStop, which one do I think long term has the best chance of doing well? It would be Tesla. And Tesla's probably overvalued at this point, especially for the current market conditions we're in. But GME and AMC, there's definitely not as much of a fundamental basis to sustain those kinds of prices long term. All right, let's look at some of these questions that you guys have here. First one being from Kevin. Good evening from Lakeland. Good evening, man. It's always great to have another Floridian in here. But the first question goes to the Ultimate Trader. And he asks, what do you see Apple doing? Let's pull up the Apple chart here. Just for the sake of room on this chart, I'm going to take away the question so I can push my chart my face right back down here. Get a cleaner. There we go. So you got this bull flag pattern here. And what we saw today was pretty interesting because we broke out of this bull flag pattern, but into the close, you saw some heavy selling that took price back down to 170. But it's still outside of this bull flag pattern. So it's broken out. I wouldn't say it was the most convincing breakout. And I'm never a fan of stocks that hit the bottom end of a massive bull flag pattern, or any bull flag pattern for that nature, unless it's a very tight one, because then the reward to risk ratio, it can be better managed. But in this case, we go all the way down to 149, or what was it? The lows was about 150, right? Yeah, 150.10. And we go straight back up to 170 where it breaks out at. That's really hard to get long on it at that point in time, because for what we could be seeing here is similar to what we've seen going all the way back to the beginning of the year, where when we test this upper channel band, we sell off. And this might just be a case where it sneaks a little bit outside of it, can't sustain the momentum, and now tomorrow we're going to have a pullback. So there's no doubt there's a lot of people that got sucked into this trade on this bull flag breakout. But the way you could have kept yourself from getting in on it as well is by not getting, is by noticing how much it's rallied over the last 7 days, realizing that, okay, if this thing's going to be legitimate, it needs to consolidate some at the very least. And then that consolidation, let's say if it consolidates, between about 166 and like 169 over the next few days, or let's see, go even further. Let's say like 164 and 169. And it consolidates nicely, and then it breaks out above like 170, 171. Then you can put that stop loss below 164, and then you have a tight reward to risk ratio. The other question to ask about to yourself is that, okay, once we gets up to 182, is it necessarily going to be able to break out above that level there? So those are some big questions. Remember, this is a $3 trillion stock. How much more valuable can Apple get at this point? Is it a $4 trillion company, a $5 trillion company? There seems to be some pretty good demand for the iPhone 13, but I don't know if that's necessarily enough to take it up to 4 trillion from here. And here's something that's interesting. And I mentioned this on the YouTube membership earlier today. This move today, this is equivalent to 2 Netflixes. the value of 2 Netflix companies is what this move represents. That's about $370 billion. That's 2 Netflix companies that Apple jumped by in just, 7 days? Crazy. Is Google a buy? Let's look at that one here, okay? Google a buy. GOOGL. So head and shoulders pattern here that's formed. Kind of, right? What throws it off is this massive earnings report where it went right up to all-time highs, the stock split and everything else, and then it came right back down. If you could take that out of the picture, it probably would be a head and shoulders pattern, but nonetheless, you can say it's just a crazy looking head and shoulders pattern, or just say it's a double top. I lean more towards a double top because you got one top here, the second top there, and when you look at the chart, it's still sitting inside of this massive range. So I don't necessarily like it from a long-term perspective here. I think there's a potential, especially if this market continues to weaken like we saw in the first 2 months of the year, that Google goes down with it. But in the short term, it's a little bit different here. You have the potential for a double bottom breakout here. It's actually already taken place. It pulled back a little bit today, but you could see a possible pullback to 27.28 and then another march back higher to 3,000. That would give you about a 10% return for the amount that you're risking, which I don't think I would put a stop loss any further than like 26.40 on that particular play. But that's really not bad. If you can get in at like 27.28, put a stop loss at around 27.40, and you have about $80 stop loss there, it goes back up to 3,000. Pretty good reward to risk, right? Great reward. The question becomes, if the market struggles from here, and there's everything that says that it should, there's emergency rate cuts on the table of 0.5%, or not rate cuts, rate increases. Okay, so the Fed's talking about, I'm so used to talking about rate cuts over the years, can't get that out of my vocabulary. I'm not used to rate hikes. Rate hikes of 50 plus basis points over the next 2 meetings, and possibly even an emergency rate hike. So keep that in mind, because that's not going to be good for the market. The market will respond negatively to those kinds of events. So if you think that it's just, straight up from here, that's going to be a tough sell for me personally. So I'm not getting long on a lot of stocks right now. I don't really care to. I've been very patient with my trades and plan to continue to do so from here on out. I'm net short on the market right now. If you're wondering what I'm drinking, it's Old Scout. Good stuff here. One of my favorite everyday sippers. If you listen to my podcast, I review a different bourbon all the time, always talking about Old Scout, though, and how good it is. I am really solid bourbon. And no, I don't drink during the trading sessions. I just do this during the Wednesday live streams and during my podcast. Okay. Google, we got that one answered. Greetings from Budapest. I have 2 questions today. Well, let's get it from Victor here. SPY. How likely is it to come back south to the March lows? That's a good question. And that's one I think a lot of us are really curious about. So pulling up the SPY. You got SPY coming all the way down to these, February 24th lows. And what's interesting is both the lows from this year have taken place. The January 24th lows, February 24th lows. So maybe there's something magical tomorrow that's about to happen with us coming up on March 24th. I mean, that have to be pretty significant for us to make new lows tomorrow, but and I'm not calling for that either, so please don't quote me on that. This 200-day moving average, and I said I was going to do the SPY and the Qs and Russell anyway, so I guess it's a good opportunity to do that right now. The SPY, it's losing value with this 200-day moving average. Everybody likes to talk about 200-day moving average, but when you can slice below it and above it with relative ease, and then it comes right back up again yesterday, breaks above the 200-day moving average, which typically is significant, and then breaks right back below it, it doesn't matter anymore. 200-day moving average, I couldn't care less about, because the market doesn't care about it. The S&P 500 doesn't care about it. So if it doesn't care about it, why am I going to care about it? So moving averages are only good when the chart cares about it. So if there's like a relevance to the 50-day moving average, or the 20 or the 5 or the 10, that's worth paying attention to. But if the market doesn't act like it really cares, I'm not going to care about it either. And in the case of SPY, it's been ripping through moving averages of every sort. I haven't looked at the 100-day moving average, but let's just pull that one up. So it's actually still below the 100-day moving average. And you can see here, it's had a couple of moments here with it in the past. Yeah, you know, I mean, I'm kind of like talking about this in real time here, but watch this 100-day moving average here, because it's definitely bounced off of it on multiple occasions in the past. So we haven't quite gotten up to there today or yesterday, but if we rally tomorrow, maybe there's a possibility that it tests that 100-day moving average and it sees a rejection there. So really, for this downtrend to continue, it has to break these February lows. There's really no getting around that. There's a little bit of a rising short-term trend line there to where you have higher lows in place. So if it comes back down, it could test that and bounce at around 420, 421. No jokes, please. But that's one thing. So for the bears to lose the momentum or the handle of this market, it has to get above these February highs. It breaks above the February highs. What you have here is a break of the right shoulder of the head and shoulders pattern. Now, this head and shoulders pattern goes all the way back to it started forming in like July, August of last year. So it's a massive pattern. If this head and shoulders pattern fails by price getting back above the February highs at about 457, so essentially it would have to rally about another 140, 150 points to get back above it. That would nullify the head and shoulders pattern. So that would effectively change the whole landscape of this market. Until that happens, the bears still have control. But yeah, I mean, the rally this past week has been pretty significant. It did, from the past week, it managed to break this higher, the previous lower high. So when it breaks that, it establishes a new trend line. So you have a series of higher high and a higher low now that's in place. Pretty big deal for the market. All right. So that's SPY, personal history. Do you remember the biggest 2 to 3 drawdowns you witnessed in your trading career? Yeah, probably the biggest one was back in 2000 when the dot-com bubble burst. That was one of the most difficult moments there. Reason why was because I had just started trading probably about 10 years earlier. I started trading, if anybody knows my history, I started trading when I was 11 years old. Inherited about $5,000 from a lady that raised my mother. She lived down in Miami Dolphin hat. And so she raised my mom. When she passed away, she left all the kids $5,000 for college. I was 11 years old. So my dad said, hey, let's put it in the stock market. Really cool, right? I learned a lot about the stock market at that time. That's how I got my start. I'm very fortunate and blessed that happened. And it was during a time when the market just was like, you thought the market was printing money back in 2000, 2001, or 2020 and 2021. You should have seen it back then. I mean, it was crazy stuff. Millionaires were being created every single day in the market, especially with the tech bubble and the dot-com stocks. So when that bust, I didn't know anything about risk reward. The whole market fell apart, and I was just, bag holding all my mutual funds that I was in at that time. So that was the biggest drawdown that I ever experienced, because I saw a portfolio that went from like $50,000 and change minus the gateway computer that I had bought when I was 16 and fixing my transmission when I was in college. And I saw that whole thing just blow up. But I mean, I did come away with a profit from it all. However, it did teach me a valuable lesson. When you see your portfolio go from $50,000 down to, I want to say it was about 17 or 18,000. It leaves an indelible impression. So that's where wanting to manage the risk and get better at it arose from. I didn't learn it right away. It took many years thereafter. I started getting into some penny stocks coming out of college. Those were big mistakes. That's probably the next area where I saw some of the biggest drawdowns when I wasn't trading with big money at the time, but I was losing quite a bit trying to get those penny stocks to work in my favor. All right. Good question, Victor. What do I think of ORGN? Let's go back to the charts and look at ORGN. I'm wondering if I'm going to get an MULN stock, because I've been getting asked all about MULN. of late. So maybe I'll just throw that out there just for kicks, because somebody's got to be wondering about it. ORGN, I've never traded this one, or at least I don't remember trading this stock. But downtrend for what, past couple of years, it looks like, or about the past year and a half. Bull flag pattern over the last 4 days. So that's kind of pretty interesting there. It's a little bit more volatile than I would want to play, but I know not everybody has the same approach to trading as I do. So if somebody looks at this stock here and says, hey, I can manage the risk on that trade pretty good, then all the more power to you, man. Because some people actually can manage the risk a lot better than what I can. But in general, these are kind of difficult stocks to manage the risk on. So higher lows right here, higher highs right here, and here. Bull flag breakout. So if it can break back essentially above the highs from today, which should push it out of this bull flag pattern at around like 696, stop loss. Actually, it's kind of crazy. I'd probably put the stop loss below the lows from today, which would be like 672. So below that, that's how I would approach it. It's actually manageable from a risk reward standpoint. I don't know what kind of headline risk this thing has, but it's definitely interesting. Also, too, there's some support kicking in here as well. Look at that. Some nice support here going back to December, January of this year. So that's pretty cool. Yeah, pretty interesting, man. I tell you what, I'm going to add it to my long watch list just for the sake of it, because I do want to watch how this one performs in the coming days. But cool. I like that one. Barry Sycamore got a Tesla put today at 1025. Wow. So you should have seen a pretty good fade. That you should be doing all right on that one so far, depending on where the expiration is on it. The ticker X. Alex Ramirez looking for some action in steel, or he may already be in steel. I can't remember from previous ones exactly, but definitely a nice rally. I think at this point, if you're going after steel, you're chasing it, and we don't want to be chasing stocks. That's where a lot of people get killed on the bag holding side, because if something changes, let's say something changes with the war in Ukraine, or inflation starts to get a lot better, a lot quicker, things like U.S. Steel are going to see some dramatic pullbacks. So you want to be careful there. I don't see a really good reward to risk ratio, but what I do see, and we were talking about moving averages, when the market respects a moving average, it's worth respecting. So with U.S. Steel, you have the 10-day moving average in play here. This 10-day moving average, this orange line here, it's done a pretty good job of holding that level. I mean, look at that, constant bounces. It'll dip below it intraday, but it doesn't close below it, and that's been going on since when? It's been going on since late February, right? So that's pretty good for the 10-day moving average, February 24th. So while the intraday dip may not hold, a close below would definitely be notable to me. So right now it's trading at 35.87. Maybe if there is a bounce off of this 10-day moving average, you could probably play it more like a scalp or a quick 1 or 2 day trade. But trying to establish like a swing trading position, hoping that it's going to go up another 20 or 30%, could happen, but the risk reward ratio is going to be much more difficult. So he got it. So Alex got in at 31.30. Oh, 31, and his stop loss is that. So he's sitting on some pretty good gains here. You know, what is that, about 15% or 12% there? So nice move. And he's got a stop loss at 30. But yeah, I like the idea of using that 10-day moving average. For me, at least, I'd be using that 10-day moving average, a break below, or a significant break below. Let me back up. A significant break below intraday, I'd want to get out. The other one would be if it closes below, I would want to get out. So if it's just something like this where it breaks below it a little bit and then starts to rally back, that's not going to get me out of the stock. Good chart. So thank you for bringing that one up. What about Para? How did I miss Jose's earlier? I skipped right over him, man. Sorry about that, Jose. Jose asked, what about Para? Look at this thing. Talk about it, just a massive, massive basing pattern, right? So is this like Paramount Pictures? I don't know what it is, but it's starting to break out above it. And then if you even look at it from the short term, you can say, okay, maybe there's like a fresh breakout in the short term as well. So you got this little fresh breakout going on here. Big question is, where do you put the stop loss at? So for me, I try to want to put it below as many candles as possible. One take would be maybe wait for it to pull back again to this, because a lot of breakouts will do this. They'll pull back to the breakout level. So in this case, it'd be like 36.23, and then it'll bounce again. That's not always guaranteed, but it's a possibility. So you do that, then, maybe a stop loss below these lows from March 15th at around 30, I don't know, like 34.41, that could work. So that's one take. Or, you could also just say, hey, if it breaks back below this breakout level, I don't want to be in it either. So then at current prices would be your entry, and then maybe like a move below 35.60, you'd be out. So a couple of takes on how to play that. Thank you, Jose, for that one. Barry's got some Walmart going on here. Got into Walmart 142, put April 1st, and Costco got a 550 put April 1st. My reason is that S&P 500, Nasdaq, and Russell 2000 all seem to have reached levels where they have a lot of resistance. Good idea. It's a tough one because both Walmart, now we'll look at Walmart. It's seen a little bit of selling of late, but I mean, it's withstood a lot, guys. I mean, even like the 2020 sell-off, yes, it went from 146 down to like 125. Not nearly a sell-off that you saw in a lot of other stocks, though. I mean, you take like take Netflix, right? No, that was a stay-at-home stock. You take something like Square. What did it do during the sell-off? That thing went from like 87 down to 34. Actually, was I looking at the right time frame? No, I wasn't. Okay. It was actually not even as bad as I just mentioned. I was looking at that and thinking that was the 2020 sell-off, but no. Walmart, it was just a lot of volatility here on the Walmart side going right here. That was the sell-off. So it was really messy. It was a stay-at-home stock, but Walmart does a pretty good job of holding its own. It's one of those boring stocks you can trade. So I don't know if I would be expecting big moves out of the stock. Same thing with Costco. These are both like staples. They're defensive sector. So Costco, defensive stock. Walmart, defensive stock right there. Defensive stocks tend to go down less during a bad market than, say, tech, discretionary, healthcare. What am I forgetting here? Energy, typically. You got industrials. They all tend to fare far worse than like your discount stores. All right, let's look at the Nasdaq because we have Renee asking about that one. Do I think that Nasdaq will revisit 1255.5? So for those who don't know where that's at, let me pull up the actual Nasdaq chart instead of the Qs. Here's your 1255.5 here, right at these lows. I think the lows that the market hit was 1255.5. Do I think it'll get back down there? So let's go back to the Nasdaq chart here. It would essentially be the equivalent of breaking below the March lows. I think so. Personally, I think we have a long road. The market has a long road ahead of itself, right? Doesn't mean that you won't have a lot of dead cat bounces in the meantime. But if you look at the 2008 sell-off, right? Where's that joker? Look at this. We always think about the Great Recession as just being like this straight down moment. But look at some of the moves that we had. I mean, going from March of 2008 to June, massive rally, like a good solid quarter there. In fact, that might have been a quarterly rally in the midst of So you had a little bit of a positive quarter there in the midst of 2008. So, but again, back to this, you can have some pretty big rallies here until the ultimate sell-off does happen. I don't think we've seen this moment yet out of the market. I'm not saying it's going to be as steep as that, but I think it's going to be pretty gut-wrenching. So here you have a decent sell-off, and then we've had a pretty good dead cat bounce. A lot of things happen a lot faster now than they did back in 2008 or 2000 because of how quick the market can react to news and how fast they react, how that fast the trades can be made, and how much panic can ensue. I don't see that where we've actually seen a major level of panic. Also interesting too is this 100-week moving average. This thing keeps popping up as being interesting to me, but it's kind of like a 2-year moving average on the Nasdaq. 100 weeks, 50 be about 104 weeks, but nonetheless, though, there seems to be a little bit of legitimacy here to that 100-week moving average, worth keeping an eye on. So I do think it can. I mean, in the grand scheme of things, from a weekly chart, this could easily sell right back off again. Where I would like to see the Nasdaq get down to, can it get down to this 300 level? If it does that, I think it would be pretty ground shaking. And then while we're looking at it, let's look at IWM real quick. For a long time, I had drawn this resistance level. Let me pull it up on the daily. I had drawn resistance as being like something like this. But then after what I've seen over the past couple of weeks here, or a couple of months with this chopping pattern, it looks more like this should be the resistance level that we're focusing on. You can see we've rallied twice up to it, and we've sold off each time. We've held it here, we've held it there, we've held it again back in March and February, or twice in March. So definitely the resistance level that I want to be watching going forward. All right, let's get another one going here. Amazon, is it a long-term hold? We talk about Amazon a lot. It seems like it comes up a lot. But when you're looking at Amazon, you have a massive channel that it's been trading in for a very, very long time. So we've had a couple of moments where it's managed to sneak out above and below, like it broke out here, but it came right back down inside this channel. And it did it again here in November of last year. And then you had the sell-off on multiple occasions. It came right back down below it, and then it popped right back up. This channel is just, it's been a magnet for the stock. It's not really broken down. So hard for me to say, yeah, this is a good stock to be in right now when it hasn't really done anything since what, August of 2020. It's just been a time trap for your capital. And then Ragi asks about, I don't know if I said your name right, but how about Wish? Let's talk about Wish. Let me do this too. And I'm not sure, but it looks like I may have lost. There we go. I wasn't sure if I lost my internet connection there for a second. But perpetual downtrend, guys. When you see stocks like this, it just like never can get things right. Reminds me of like being a long-term trader of like FAZ or something, you know, like a 3X bear or UVXY. It's easy to get trapped in these things. So like Wish, it may be good short-term, but it would be hard to put faith in it from a long-term perspective because nobody else has. So I don't know. I can't really find anything to work with here. Yes, it broke this little mini downtrend, but even that's not anything to write home to mom about. Is it going? Yeah. It's not a bad, but I wouldn't say it's a lot of conviction in that stock at all. Jose, glad you enjoy the charts. I'll keep posting those on StockTwits all the time. Do I think Tesla can finish over 1,000? I try not to be too much of a predictor of price movement or what a stock will ultimately do. It's impossible to know what a stock will do on a given day. I mean, news could come out tomorrow. Who knows? I mean, it traded at 99.11. There's a good chance it's going to go over unless we have a gap down tomorrow. It'll go over 1,000. But I don't know if it's that big of a deal, whether or not it goes over 1,000 or not tomorrow. I would look at, and we've talked about this some already, so I won't, beat a dead horse, but I would just look at it. Is this a really optimal time to be trying to get in? For me, I'd probably wait for a pullback. BZ, man, he has a good dividend to it. He cannot catch a bid at all. I actually have some of this in my dividend portfolio. Just a lot going on there that's not all that great. I mean, Verizon's not really a stock that I buy for the chart. I pretty much just buy it for the 6 or 7% that it pays out in divvies. But yeah, right now it's definitely struggling. You know, you could say this is some support here. It needs to hold this $50 level. If it can hold that level and bounce, that can make for a good little bounce opportunity. But again, it's kind of like Walmart and Costco. I don't consider these to be high movers. They rarely show up in my scans. Costco does to show up in my scans some, but Walmart and Verizon, AT&T, they just don't. So thank you, Renee, for that comment there. How about some Apple? Do you think it could hit 180? We've talked about Apple some here, so definitely go back. Or did we talk about Apple? We may not have. I think I talked about it in passing, but essentially this bull flag pattern, do I think it goes back to 180? I mean, you'd be talking about all-time highs at that point in a market that's you're raising interest rates, which are not good for tech stocks. My gut tells me no, but my gut's wrong a lot. So I would just look at this bull flag pattern here. Yes, it's breaking out of that bull flag pattern, but because of how big it is, are we looking at just another sell-off that takes it right back down to the lower channel? It's possible. That's also possible too. So with these kinds of moves here, they can exasperate a lot of the buying, and it doesn't necessarily make it something to where you want to be trying to get in at this level after it's already made of like a $20 move. I mean, it's like 12, 13, 14%. So I would move on to the next trade and find a better opportunity. This market does have like a 2000 or 2008 moment. There's going to be so many good, really good trade setups that come your way. What kind of craziness is this, Barry? NVNXF? Novonix Limited? I can assure you I've never traded this one before. Good grief. Downtrend in place, that's for sure. You got a little bit of a base. This thing, crazy gaps. This is a red flag for me, okay? Red flag is these gaps because guess what? You buy it at 540 one day and you wake up the next day, it's at 480. Dude, you can't trade that kind of stuff. I mean, that's too much capital at risk for it to just have these haphazard gaps lower, 540 to 470. I mean, from a technical standpoint, yeah, it's trying to break out of this base and everything, but you're really rolling the dice on some crazy price movements there. All right. Aristox market. I can't get to all of those, but that's a bunch of them. I'll kind of go through them real quick and without going into too much detail. I mean, it kind of got a basing pattern there with MTTR. I don't see anything too exciting there. SoFi, I don't like SoFi at all. I mean, you got this massive support level that it broke below. You also have it's just a series of higher lows and or lower lows and lower highs in place already. I mean, from the highs that were from November. I get more hate about my comments about SoFi than any stock that I talk about. But in the end, man, this stock is still underneath that resistance. So, and we got lower lows and lower highs still. So, I mean, this looks like a possibility for another lower high here. This is why this is the kind of year that you should be realizing how important stop losses are. If you're not using stop losses, you're setting yourself for disaster. You got to use them, guys. SoFi, what was some of the others that he had on here? SPPI. I mean, that's a chaser there. It's a great move, but it's a very volatile move. Stocks like that, I mean, I would be taking profits along the way and then trying to get to this like ride or die level. Maybe that's like a third, 0.25%, 10% of your trade position that you can just kind of let it run wild. But these are stocks that are very difficult to manage the risk on to any great degree. HNST, I mean, there's some support at $5, but nothing crazy good there. This might be one of the more normal stocks that have been offered up here. watch this resistance here on Disco at about 30.72. You can see it right here. Some heavy resistance there. It's slightly declining, but that's going to pose some problems for the stock if it gets back up there again. Yeah, like Mark said earlier about NVNXF, very, very low volume here. Okay, so, and thanks, Mark, for being here, man. Glad to have you. Mark's part of the trading block, man. He's like one of my favorite guys in there. He's always there offering up some great insights. Cat, talk about Cat sometime today. Oh, it might have been earlier, but not in here. But Caterpillar, holy cow, I got some craziness going on there. But Caterpillar, you got kind of like, it was interesting because I compared this to Apple, even though they're not the same industries, but you got this massive bull flag pattern and it's bounced off of the lower channel and gone straight back up. So even if it breaks out, you got to be a little bit careful with it. But what would be nice is what we've seen over the last couple of days here, where it's trying to consolidate here underneath that resistance. If it can do that for maybe like another week or so and then break out, that would be good, because then you can at least keep the risk tight and see how far it wants to run, and it'll work off those overbought levels here that you're seeing at about 85, 86. Let's see, how about PTON? Yeah, this one has got a lot of headline risk. I mean, it's coming up on some resistance here from that big massive gap down in November, but people going back to work, it hasn't fared too well with PTON and Peloton. And essentially, what is Peloton? It's a bike with an iPad on it. So even Apple doesn't want to buy it, or at least not yet. So Peloton, if it did manage to rally, 81 has a lot of resistance, but that's not in the here and now. That's a long time from now. 39 would have some resistance. But again, another stock you really want to manage risk on. You don't want to let these kinds of things happen, especially holding stocks through earnings. For a stock like Peloton, that's like disaster in the making. Max wants to buy some Adobe. There is an inverse head and shoulders pattern working on Adobe. I don't know if it's going to materialize, but that dip down today following its earnings, that does create a potential for a inverse head and shoulders pattern to form. I mean, look at this sucker. You got the left shoulder, and then you got the head that dips down a little bit further here. Okay, and then you got the right shoulder. So if it can pull it off, it would be amazing. But yeah, that would be your breakout level if it can get back up there. It's going to be really interesting to see how it performs tomorrow. But for me, yes, it sounds exciting to buy a stock that just sold off 10%, but there has to be a reason to buy it. It has to develop from a reward risk standpoint. So right now, if you buy into it, okay, maybe you can get it back up to this, 10% higher, but you're putting this, I don't know. I just don't see it just yet. It's not really a bullish pattern at this point. We got PLTR. This is another one. I think there's a lot of people that are stuck on this trade. My heart goes out to you guys because I know it sucks to be underwater on some of these stocks in such a glorious fashion. Double bottom. I'm not going to call that resistance here. Let's drop that one so it's not distracting us. But double bottom, it's starting to break out here, but you got to be a little bit leery of what kind of resistance looms right above here, because it stalled it out back in February. So are we going to stall out again at this 1426 level? And remember, these are sensitive price points because people are thinking to themselves, okay, I got in at 14 and it dropped all the way down to 9. If I can just get back to break even, I'm going to get out. So that's where your resistance gets kicked into high gear. It gets back up to 14. People are like, I got to get out. But keep that in mind. I mean, there's not a lot of good reward to risk ratio right now if it can't break above that 1425 level. MNMD, does it look like a crash and burn scenario? I mean, it's a biotech stock, so there's a lot of risk that comes with biotech. I don't trade biotech personally on an individual basis. I'll trade IBB, but I won't, which is a biotech ETF, but I won't trade individual names. I could do Gilead, but that would probably be about it. MNMD, nice basing pattern. Or, geez, you're talking. Yeah, it's trading at $1.17. It's a crash and burn. I mean, I don't know what it does in the future, but I could find a million different places for better to put my money at than MNMD, in my personal opinion, at least. Ben likes the analysis. Have I found any old Scout port cask yet? I found another old Scout. I know they got some up in South Carolina, but I haven't been able to make my way up there. I might try to get my brother to go get me someone because he lives up there. But I'm going to try to get some. I think there's another one at Total Wine, though, and I can't remember if it's a port cask or not, but it's a different, like maybe like a small batch or a single barrel. I got to check it out. All right. We got a couple more here, guys, and I'm going to wrap it up because I have a son that I got to go pick up at school here. He's at a math competition. Who knew, huh? I can do addition, subtraction, multiplication, division, some fractions, some fancy stuff. Whatever I need to be able to get into a trade, I can do that. But kudos to my son for being a math scholar. All right. Would I short oil? No, I wouldn't. I mean, that's like trying to step in front of a freight train and hoping that it's going to stop. You're putting yourself at risk for some serious damage there, especially with how much we've seen it rise overnight. I mean, ultimately, I think it's going to come back down at some point. It's just a matter, if you can hold through some of the shenanigans that it puts you through in the meantime. Devon Energy, DBN. Yeah, this is another one where it's really hard to buy these things when they're at their highs like this. You gotta pull it back. If you're dead set on buying these things, you want to buy it on the dip. So, for that, it would probably been, a pull back to this trend line here at around 52. Now it's trading at 61. So I always say if you miss an opportunity, there's always something else that you can aim for. So Devon Energy, from a long-term perspective, I think it probably pulls back to 40. That might not be in the here or now. We've seen plenty of stocks get completely disattached from their trend line like this one's doing. But ultimately, that would be where I would try to get back in at. Again, that may not happen for a while, but. And then we got ASAN. Let's see here, ASAN. I mean, there's definitely some resistance there, but what would cause me right now to want to get into the stock? Maybe breaking this declining trend line. I don't think that's enough for me to get interested in it because it almost looks like a bear flag pattern right now still. So I would be a little bit nervous about that. Yeah. I don't see much here, guys. There's also some resistance right here in the short term. Technical analysis is a guide. Support resistance is going to be broken. It's going to be held, but it's the guide. It's what it tells you ultimately. Okay, right now it's not able to break through. If it breaks through it tomorrow, then that's a new input that you have to consider in the technical analysis. So overall, I think it looks a little bit more on the bearish side. Barry says it looks like MNMD. Yeah, I mean, it's definitely not in the $1 range yet, but golly, that thing's gone from 140 down to 44. So it's definitely closer to an MND status than it is to its all-time highs. And then Microsoft. Yeah, so I was talking about this earlier today. You have kind of like a double bottom here, and then it's trying to break out. It broke out yesterday, but then it did a nice little head fake. And I'm worried that a lot of these breakouts that we've seen of late is going to start trickling into a lot of other stocks that have been doing really good over the last 7 days or since the March 14th lows. I probably sound a little bit redundant when I say a lot of this stuff, but keep the risk in mind on all your trades. I didn't really buy into this rally, okay, at all. And I don't feel bad about it. Look, the rally started last Tuesday. How many rallies have we seen last more than a day or two in this current market environment here in 2022? Not much. You had like a 4-day rally and you had a 3-day rally, but most of the time they didn't last very long, and the bulk of the gains were made in the first couple of days. Then the next day you had the FOMC statement where they're going to be raising interest rates. I'm not going to get it long on ahead of that, but yet the market still rallied. And so at that point, okay, we're 2 days into it. Reward to risk is already skewed. I'm not going to get into it. So, Thursday and Friday come and go. I don't buy into it. And so here we are on Wednesday, and I'm now back to being net short as of like 10 minutes before the market closed. So I think that if every market rally was meant to be bought, trading would be easy. Okay, you just buy into every rally that there is because you'll be profitable. But that's not how the market works. Sometimes you have to say, hey, I'm not going to buy this rally. The reward to risk is not right. And you do that and you sustain yourself in the long term. So sometimes you'll be right, sometimes you'll be wrong. But in the end, you're preserving your capital at all costs. And sometimes that means missing out on a market rally. So if you enjoy this, again, check out down below where like the channel, and make sure to subscribe to the channel as well. Like the video, subscribe to the channel, and that'll make it to where you get notifications when I'm doing these videos in the future and all the other content that I provide quite regularly. So thank you guys, and God bless.